Are you interested in flipping houses but don't have any money to get started? Well, you're in luck because today, we're going to share 7 proven ways you can start flipping houses with zero cost. 1. The first method is called wholesaling. With wholesaling, you find a distressed property, get it under contract, and then assign that contract to an investor for a fee. You don't need any money to do this, just time and effort. House wholesaling is a terrific way to flip properties since it gives investors the chance to make a lot of money quickly. Finding properties to sell, putting them under contract, and then giving the contract to a different buyer are all steps in the procedure. The final sale percentage, which is often between 5 and 10%, is how wholesalers are paid. Since buying homes is not truly included in the wholesale process, it is a fantastic way to enter the real estate market without having access to financing. One thing to keep in mind as you think about taking this path is that neither wholesale properties nor customers will appear out of thin air. Despite the fact that this is a very lucrative opportunity, investors will need to work hard to be successful. This necessitates maintaining a constant eye on the market, establishing contacts with prospective purchasers, and developing contract negotiation skills. Investors will, however, be well on their way to acquiring their first rehab property if they make the necessary efforts to be successful wholesalers. As an added benefit, as investors advance to flipping homes, the knowledge and contacts needed for wholesaling will undoubtedly be useful. 2. The second method is partnering with someone who has available funds. Find a partner who has the capital to invest, while you bring your expertise to finding and renovating the properties. Split the profits and create a win-win situation. There is no reason why your partner cannot fund the deal as long as the appropriate connections are formed and you contribute something worthwhile. However, it is important to keep in mind that you had better bring a lot of value somewhere else if you aren't contributing financial resources to the partnership. You might truly be aware of a deal, or you might just have the necessary connections. You must carry your own weight as a partner in any situation. Partnering with investors who already have funds is, at the very least, a terrific way to get started in investing. 3. This brings us to the third item, private moneylenders. These are individuals or companies willing to invest in your house flipping project. Pitch your plan, show them your expertise, and negotiate mutually beneficial terms. Private lenders will most frequently be the primary way that people find funding for house flipping. Private moneylenders are simply banks without the interminable red tape that traditional lenders have come to be known for. Private lenders, then, are any individual with a few extra bucks in their wallet, an interest in investing, and a willingness to listen to a potential business idea. They are not affiliated with any financial institutions or government-backed organizations like Fannie Mae or Freddie Mac, which is perhaps even more significant. Making that distinction is crucial because it allows them to establish their own norms. However, since they set their own rates, private moneylenders often come at a high cost. It's not unusual for their fees to range between 6 and 12%. They have the flexibility to create their own restrictions. Private moneylenders can have the money in an investor's hands in as little as a few days or even hours, despite the fact that their typical interest rate is a little higher than a regular lender's. The ability to act quickly is what working with private moneylenders offers the most. If it means that an investor can acquire funding in the shortest amount of time feasible, the slightly higher interest rate is definitely worth the price of admission. Unsurprisingly, the majority of investors will discover that the time it takes to make an offer is more significant than the interest rate it carries. Traditional banks, on the other hand, could take up to 45 days to close a loan, which is just long enough to let a chance to make a transaction slip through your fingers. A promissory note plus a mortgage or trust deed on the underlying property are typically required by private moneylenders as a sort of insurance policy. Some private lenders may even demand that borrowers go one step further and use their own assets to guarantee the loan, but anything is possible. 4. Another option is to use hard money lenders. Although they charge higher interest rates, they are more flexible in lending to novice flippers without a financial track record. Hard money lenders are essentially lending firms that provide specialized, short-term reality-backed loans. They are associated with a business that specializes in lending, unlike their private money equivalents. However, in order to minimize confusion with conventional lending institutions, hard money lenders often issue loans with shorter maturities. Hard money lenders often adhere to a 6-month to 2-year term, in contrast to transactional lenders, who will issue loans for up to 15 and 30 years. Hard money lenders will function very similarly to private money lenders, with the exception of their connection to a real business. In addition to having much more flexible lending policies than conventional institutions, they also charge slightly higher interest rates. Hard money lenders typically demand between 11 and 15% of the loan amount in addition to 5 points, which are additional upfront percentage fees based on the loan amount. Notably, there are no common standards for hard money lenders. Instead, they all have their own unique requirements. Hard money lenders can be used to finance all home repairs, according to specialists at New England Home Buyers. Hard money borrowing is not dependent on your creditworthiness, unlike conventional bank loans. However, hard money loans usually have higher fees and interest rates. Be aware that points can range from 1 to 5, and interest rates can range from 8% to 15%. It is also crucial to remember that the majority of hard money lenders will often only lend a portion of the purchase price, typically, about 70% to be precise. If they don't want to spend any money out of their own pockets, most investors will have to turn elsewhere, possibly to a private lender. Consequently, if an investor is utilizing a hard money lender, they should keep in mind the 70% rule. Pay no more than 70% of a property's after repair value, minus the cost of the repairs required to refurbish it. That is, figure out what the property will sell for after it is rehabbed. Then, multiply that amount by 70%. Afterwards, subtract an estimate of the repair cost, and use the resulting amount as an estimate of what to spend when investing in a property to flip. Conventional lenders, such as large banks, base their decisions on the borrower's criteria, including things like credit score and debt-to-income ratio. Hard money lenders take into account the borrower's income and credit rating, but these factors are not as significant as they are for banks. These lenders may be private individuals or small companies, and each will have a different set of requirements for loans. As a result, hard money loans are frequently determined by the investment property at hand as well as the value of the deal that is being offered to them. Before approving the loan, they will assess the property's after-repair value, ARV, and the rehabber's dependability. Hard money lenders, unlike most large lenders, will fund properties that need repairs, but they will also have higher interest rates and less favorable terms than conventional lenders. 5. Ever thought of using a home equity line of credit? This form of financing allows you to tap into the equity of your primary residence to fund your flip. There are a few ways for homeowners who have equity in their current residences to get cash. The first method is to refinance with a cash out. Your current mortgage will be redone, and you will keep the difference between the two loans. There are no limitations on what homeowners can do with this money, so it might be used as a down payment for an investment property that they fix up and then sell. In order to buy a rehab property, homeowners might also investigate a home equity line of credit, HELOC. With a HELOC, investors can borrow money against their equity and make monthly payments just like they would with a credit card. These loans will give investors a lump sum of cash, which will be a terrific beginning for flipping homes. The nicest thing about this choice is that, in some circumstances, the interest on a HELOC may be tax deductible. To take advantage of these choices, homeowners must have a specific level of equity in their home, which varies depending on their lender. Generally speaking, your chances of being accepted are higher the more equity you have amassed. Finally, if you borrow against your home, keep in mind how much equity you will still have in the building. Many homeowners will choose to keep at least 20%. 6. Have you considered crowdfunding? With popular crowdfunding platforms, you can raise money from multiple investors who believe in your flipping skills. It's a great way to get started with no upfront capital. Crowdfunding relies on numerous investors, each of whom contributes a share towards the entire loan. To speed up the process, there are a number of websites that connect house flippers and crowdfunders. You can search online to find them. For house flippers who are unable to obtain mortgages from other lending organizations, this is a fantastic opportunity. Utilizing a network of seasoned real estate investors is now one of the keys to financing your first real estate acquisition. You'll need to start putting yourself out there and get off the couch in order to do this. To meet other investors, go to local real estate investing groups, clubs, and events. You'll not only meet seasoned real estate investors who might serve as mentors and provide funding for your future endeavors, but you'll also probably make friends with other novice investors. 7. If you're a U.S. resident, government-backed loans, such as an FHA 203K loan or a VA rehab loan, can also finance your house flips. These loans are specifically designed for purchasing and renovating properties for resale. Through its 203K loan program, the Federal Housing Administration, FHA, provides investors with cash for renovations. This program offers loans for both the purchase price and the cost of renovation. However, it is only available to individuals purchasing homes for their own, personal use, not to investors. Even though they have some restrictions, FHA 203K loans can be utilized to purchase multi-unit properties as long as the borrower intends to reside in one of the units. This is an excellent approach to securing affordable financing for a rental property. The FHA will demand that you have at least a liquid 3-month payment reserve when purchasing a home with 3 to 4 units, which will tie up some cash. Additionally, they will demand that the 3-4 unit building's rental properties cover the mortgage on their own. That being said, a borrower of this type of rehab loan must be prepared to follow the rules. Through its HomePath program, the Federal National Mortgage Association, Fannie Mae, offers an alternate program that gives loans to both investors and consumers. The HomePath program is subject to a few limitations, however. 1. Investors purchasing houses through the HomePath program are only allowed to purchase houses owned by Fannie Mae. 2. The entire cost of the repairs cannot exceed $35,000 and may not exceed 35% of the after-repaired value, ARV, of the property. As a result, the HomePath option is only accessible for a small number of properties, and those properties cannot need pricey renovations or substantial repairs. The program is intended for those purchasing foreclosed, short sale, or bank-owned homes that primarily need cosmetic repairs. These types of homes are not typically sought after by home flippers. Some other things to keep in mind are that savings, side hustles, and cutting back on non-essentials can help you accumulate enough money for your first deal. Remember, every penny counts. And finally, don't overlook the power of networking. Attend local real estate events, join investor groups, and build connections. Sometimes, an opportunity is just a conversation away. Thanks for watching our video on zero-cost house flipping. We hope these 7 proven ways have inspired you to take action and start your flipping journey. Don't forget to subscribe to our channel for more tips and tricks about earning money. See you next time.